I want to start today with a question that I think a lot of people are asking their screens right now. It's a question that, honestly, it just feels a little bit like a sigh.
I think I know exactly where you're going with this.
The question is, are you guys even surprised at this point? And that is the literal opening line of the research stack we're looking at today. It just captures this, this visceral frustration.
It does.
We're talking about SOFI, and we're talking about yet another red day.
It's a heavy way to start, isn't it? But it's accurate. I mean, if you've been watching the ticker, you know the feeling. You open the app, you see red, and you just close the app. It's almost a routine.
Exactly. And the setup here is just, well, it's tense. The stock's down about 3% from yesterday. It's hovering right at that, that psychological $20 a share level.
And the research calls it a rough stretch, which I think we can agree feels like a bit of an understatement if you're holding it.
A massive understatement. And what's so interesting about this deep dive is that we aren't just looking at a bad day. We're looking at a huge disconnect.
Yeah.
A chasm, really.
Right. On one side, you have the market sentiment, which is just, it's undeniably bearish. The bears are in control. They are driving the bus.
Yeah, on that
On the other side, you have the company itself, the actual internal engine. And that engine is just firing on all cylinders.
So the mission today is to figure out why the bus is driving off a cliff when the engine's in perfect condition.
That's a perfect way to put it.
It's just so confusing. You see these headlines, record members, record products, and then you look at the chart, and it looks like it needs life support.
Yeah.
So let's just get into it. I want to start with the bad news, the scary stuff.
Fair enough. Let's look at the bruises first.
Okay, so the analysis points out that the bears have the momentum, clearly. But they get specific about why the stock can't seem to get off the mat. They talk about struggling to break through key moving averages. Now, I see these lines on charts all the time. But let's be real. What does that actually mean? Why does a line on a chart stop a company from going up?
It does sound like voodoo, doesn't it? But think of a moving average as a kind of a moving glass ceiling. It's the average price over a certain time. So when the stock is trading below that line, every time it tries to rally up and touch it,
People sell.
people and algorithms see it as a selling opportunity.
Yes. So it's basically a self-fulfilling prophecy.
In a lot of ways it is, and the research specifically points to the hourly and 4-hour charts. Now this is important because these are very short-term time frames. It tells us that traders are watching these charts like hawks.
So every little pop gets pushed back down.
Every single time. So if it pops its head up on that hourly chart, it hits that moving average ceiling and wham, it gets smacked right back down.
The research calls this selling the rips. Which is, that's such a violent phrase.
It is violent, and it's exactly what it sounds like. In a bull market, you buy the dip. You buy when it goes down because you trust it'll go back up.
Right.
In this kind of market, with this momentum, traders sell the rip. They use any tiny bit of green, any small rally, as an escape hatch to just dump their shares.
So they're not buying into a recovery, they're just fleeing.
Precisely. And that creates this constant downward pressure. It's like trying to swim up
A waterfall.
Exactly, a waterfall. Every inch of progress you make, the current just slams you back down. That's what this rough stretch looks like on a technical chart.
Okay, so the ceiling is made of concrete. But what about the floor? Because this is where the research made me actually nervous. We were at $20. But the analysis maps out a downside risk that, well, it's ugly.
It is a sobering look at the technicals for sure. The first line in the sand they mention is $18.70.
$18.70. Why that specific number? Is that just random?
No, in technical analysis, nothing's ever really random. That price, $18.70, it likely represents a previous level where buyers stepped in before, a support level.
So the thinking is buyers should show up there again.
They should. But the danger, and this is what the research is warning about, is what happens if they don't.
The trap door opens.
Exactly. If $18.70 breaks, if the buyers are a no-show, the next logical stopping point is $16.
16. I just have to pause there. If I'm holding this stock at 20 or 25 or even 30, hearing $16, it doesn't just sound bad. It sounds like a catastrophe.
It is.
That's a 20% drop from where we are right now.
It's a massive haircut. There's no way to sugarcoat a drop to 16. That is deep correction territory. And the research isn't saying this will happen, but it's laying out the roadmap for how it could. If that bearish momentum just keeps going, gravity takes over.
It really feels like a horror movie. So here's my question. If the chart looks this bad, if we're staring down the barrel of $16, why on earth are we even talking about this? Why not just sell and run away?
And that is the pivotal moment in this whole analysis, because if you only looked at the charts, you'd run. You would sprint for the hills.
But the author of this research,
Yeah.
they're not running.
No, they're doing something that, on the surface, sounds almost crazy. They say that the $16 range is, and this is a direct quote, where I'm personally looking to add more.
The classic contrarian twist.
There it is.
But help me understand the logic here. You just told me the house is on fire. You told me the roof might collapse down to the basement level of $16, and now you're saying great time to buy new furniture.
It does sound completely paradoxical, but this is where we have to separate trading from investing. A trader looks at that chart and sees a falling knife. They see risk. An investor, though, a value investor,
They see a discount.
they see a discount. But the question is, a discount on what? Damaged goods.
Right. Is it actually on sale for a reason?
Exactly. The author calls this a cycle of volatility. That word cycle is so important. It implies this is temporary. It's a season, like winter. You don't sell your house just because it's snowing and the driveway's icy. You wait for spring.
So the argument is that the market just has the price wrong. That it's priced like a dying company, but it's actually just winter.
Yes. And this bridges us perfectly to the second half of the analysis, the fundamental reality check. Because the only reason you would ever even think about buying at 16, the only reason you try to catch that falling knife, is if you are absolutely certain the company is worth a lot more.
Okay, let's look at that reality.
Yeah.
Because the research is just shouting this from the rooftops. The company itself is doing exceptionally well.
It's the divergence theory in action. I mean, usually a stock price and a company's performance, they're tethered together, like a dog walker and a dog. And they might drift apart, but they move in the same general direction.
Okay.
Right now, the leash has snapped. The company is sprinting ahead full speed. The stock price is sitting on a park bench refusing to move.
Let's talk about the dog sprinting. The research highlights record members and record products.
And these aren't just, vanity metrics. Record members means they're acquiring customers faster than ever. But record products, to me, is the real secret sauce here.
Why is that one more important?
Because it means those new members aren't just signing up and leaving. They're taking out loans. They're opening checking accounts. They're using the investment platform. They are getting sticky.
So they're harder to lose.
Much harder. A customer with 3 products is much harder to lose than a customer with 1. It means the business foundation is getting wider and stronger every single quarter.
The research mentions they've covered these numbers hundreds of times. You can almost hear the exhaustion in the text. It's like, guys, just look at the scoreboard. Fundamentals are screaming growth.
But the stock is whispering collapse.
So how do we reconcile this? We have a company breaking records and a stock breaking hearts. The research uses a specific word to describe it: irrational.
Market sentiment can be irrational in the short term. That is the golden rule of value investing. Benjamin Graham used to say that in the short run, the market is a voting machine. It's a popularity contest.
And right now, SOFI is the unpopular kid.
Exactly. Nobody wants to sit at their lunch table. Maybe it's interest rates. Maybe it's a general fear of fintech. Who knows? The voting machine says thumb down. But in the long run, the market is a weighing machine. It weighs cash flow. It weighs profits. It weighs the actual value.
So the thesis is basically the voting machine is broken, or at least emotional. But the weighing machine, the scale, eventually has to kick in.
Precisely. You are betting that math eventually beats mood. And right now, the mood is terrible, but the math is excellent.
And that leads to the big prediction. Because the author isn't just saying, hang in there. They're predicting something pretty dramatic. They call it a ridiculous snapback rally.
I love that phrasing. Ridiculous snapback.
It's very energetic.
Well, think of a rubber band. The market sentiment is pulling that rubber band down to 20, down to 1870, maybe even stretching it all the way down to 16. That creates tension, potential energy.
And the company's fundamentals, that's the anchor holding the other end.
Exactly. If the company was failing, the rubber band wouldn't stretch. It would just go limp. But because the company is posting record numbers, that anchor is solid. So the further the price drops away from the fundamental value, the more tension builds up.
And eventually that rubber band has to snap back.
It has to. And when it snaps, it doesn't just gently float back up.
It launches.
That's the ridiculous part. When the sentiment finally shifts, when the voting machine breaks and the weighing machine takes over, the rally can be violent to the upside. Because suddenly everyone realizes, wait a minute, why is this growth company priced like it's going out of business?
But, and there's always a but, there's a catch.
Mm-hmm.
And the catch is the timeline.
Ah, the dreaded timeline.
The research uses the phrase "in due time," which, to be honest, is maybe the most frustrating phrase in the English language for an investor.
It's so vague.
In due time could be next week, it could be next year, it could be never.
It's vague on purpose because nobody, and I mean nobody, knows when the snapback happens. We just know the conditions are being set for it. And this is where the psychological warfare really begins.
The research says stay patient and keep eyes on long-term growth, which, sounds easy to say into a microphone. It's incredibly hard to do when you're staring at a red portfolio.
It is the hardest thing in investing. You're literally fighting your own biology. Your brain is wired to avoid pain. Losing money is pain. So when you see that stock drop to 18 or 16, your brain screams, make it stop, sell.
It's pure fight or flight.
And this research is asking you to just override that instinct, to look at the record products and ignore the red chart, to treat that $16 price tag not as a threat, but as a gift, a chance to lower your cost basis.
The clearance sale we talked about.
Right. But imagine walking into a store during a clearance sale, only everyone else in the store is screaming that the building is on fire.
Oh.
That's what it feels like to buy at 16. You have to be so confident in your own analysis that you ignore the screaming crowd and just head for the checkout counter.
That is a vivid way to put it.
Oh.
And it explains why so few people actually do it successfully. It requires a level of conviction that I think most people just don't have.
Quality eventually wins out. That's the mantra the research keeps coming back to. If the company is truly quality, then quality wins. The market can't ignore gravity forever.
So let's try to package this up for everyone listening, because we've gone from technical charts all the way to behavioral psychology.
We have. It's been a journey.
On one hand, you have the technical reality, and you have to respect it. The chart is ugly.
It's a storm. You have bearish momentum, those moving averages acting as concrete ceilings, and a very real, very specific risk of a drop to 16 if that support level breaks. If you're a short-term trader, this is a dangerous neighborhood to be in.
But then on the other hand, you have the fundamental reality, the business itself.
Which is record-setting. I mean, the company is doing everything right. They are growing, they are executing in a difficult environment, the engine is perfect.
And the bridge between those two completely different realities is patience.
Patience and perspective. The research is basically telling us that this disconnect is an opportunity, but only if you can stomach the volatility. You have to be willing to endure the pain of a drop to 16 to get the ticket for that ridiculous snapback.
The pain is the price of admission.
That's a great way to summarize it, yeah.
Before we wrap up, I want to leave our listeners with a bit of a provocative thought. We've spent this whole time working on the assumption that the market is irrational and that this research is right.
Which is the standard contrarian view, yes.
But let's just play devil's advocate for a second.
Yeah.
What if the market isn't irrational? What if that weighing machine is actually working and it sees something that the record numbers just aren't showing yet? Or, to flip it around, is that emotional discipline we talked about? Is that what you have to do to earn the returns?
That is the ultimate question, isn't it? Is the market a broken voting machine, or does it know something we don't? The source material is betting on the broken machine. But as an investor, you have to decide for yourself. Are you willing to stand in that burning building to buy the furniture because you trust the blueprints?
In due time. I guess we will find out in due time.
We certainly will.
Well, whether you are holding on for dear life, buying the dip, or just watching from the sidelines, it is going to be an interesting ride. Thanks for diving in with us today.
Keep your eyes on the long term.
We'll see you on the next deep dive.